going to watch someone run down over $30,000 in credit card debt in record time. It's the Velocity Banking way. But give me one moment. I'll be right back.
You know I'm a stranger, a willing.
Okay, today we're working with an individual who actually has a pretty decent income. Remember, you don't have to have a lot of money to do Velocity Banking. It's just knowing how to work your numbers. In addition, I always say, if you don't tell your money where to go, you're going to wonder where it went. Take a look at this chart. Look at their income. Their income is roughly $4,200 a month. Their expenses are $4,218. As you can tell, their expenses are kind of high. And look at their cash flow. They have a cash flow of $25 a month. But I want you to just kind of notice something here. I always, if you look at a person's finances, you can always see where they're bleeding at. With these, I can easily see they are bleeding from credit card debt. First credit card has a balance of $17,416. That's at a 24% interest rate. They're paying $482 a month. If they continue paying those bare minimum payments, remember, large portion of that is going to interest. If they keep on that cycle, it's going to take them 65 months to pay off that debt, and they're going to give $14,000 in interest. We want to stop that. Credit card number 2, that credit card right there, $14,261 they owe on it. They're paying $337. If they continue paying that $337, it's going to take them 95 months to pay off that credit card. And I don't want to go into how much interest they're going to pay on that, but it's going to be super duper high. But I digress. Take a look at all their expenses here. They have their rent, $1,298, utilities, $267, insurance, $226. There's those credit cards there. Their food's $400 a month, streams, $86, Netflix and all that. Now remember, with Velocity Banking, we always say, consider your fun money. Just like a diet. If you think you're on a diet, you're going to quit. You're going to give up because you think, oh my gosh, I'm on a diet. It's so restrictive. With Velocity Banking, we say, put in your fun money, put in your entertainment expenses. That way you can have a good time. You can still do things you enjoy doing. Now, I will say this, if you pull back some of those fun things to get to a certain financial goal, go ahead and do it. But you don't have to do it with this, okay? No second job required as well. Okay, look at their savings account. They're putting $300 in savings. I'm never going to knock that. That is so wise because they're putting money away. But I will say this, instead of you putting it in the savings account where you're going to get pennies on the dollar in returns, put it in a high yield savings account. You guys have a video that talks about high yield savings accounts. That way your money, once again, is working for you. There's their gas. They're spending about $200 in gas a month, going back and forth to their employer. Now, let's take a look at this. They owe $31,677 in credit card debt between these two. So after talking to them, these are not homeowners, you guys. So they have pretty decent credit. That's key. You have to have at least a 660, 670 to take out a personal line of credit. Go to your credit union. I'm just really big on credit unions because remember, they work for the members. Banks have all different things because remember, they have to pay stakeholders and all those kind of things. With the credit union, they are working for you as their member. Join your credit union. It's usually $5 or $10 just to join by opening up a checking or savings account. You can go ahead and do that. Apply for the personal line of credit. In this case, I suggested, hey, listen, you have $31,000 in debt. You take out a personal line of credit. We're $35,000. Now it is at 11.75%. Remember, with the personal line of credit is higher only because there's no collateral. So they have to charge a higher interest rate. It doesn't matter, you guys, because we're going to pay this off in record time. Remember, I told you they're paying these two credit cards. They're paying $819 a month in credit card expenses alone, okay? So I'm proposing, let's go ahead, take out the line of credit for $35,000. Remember, with the line of credit, you're only required to pay on the balance that you use. So if they only take out $31,000, they're only going to pay interest on the amount that they actually have taken out, not on the whole $35,000. So I'm just a voice. They made that choice. So therefore, they've taken out that personal line of credit. They have called the credit card companies, set up payments and say, hey, listen, I'm zeroing it out. I'm done with my credit cards. They paid off $17,000 and then $14,000 here. No more credit cards, right? They're done. But you say, they have to pay that line of credit back, right? Yes, they do. But we moved them off of that amortization schedule where they're making bare minimum payments. Because you guys, out of that 482, I can guarantee you more than half of that is going towards interest. So we're going to remove all the amortization schedule. We're going into a line of credit. With a line of credit, it's open-ended. You can borrow from it, pay it back much as you need to over the terms. It may be 10, 20 years, but you have the option to borrow from that as much as you want. So we're done. No more credit card debt. I'm telling you, use your credit card to be responsible. No more running up your credit card bills. You're done. You're finished. You're at zero. So now they pay that off, but they still have $31,677 that they owe to their line of credit. Now you might say the line of credit is at 11.75%, better than that 24% they were paying, but because they have positive cash flow. Remember, when we deal with velocity banking, everything is about positive cash flow. They only had $25 up here, but once we paid off all of that, the $819 plus that $25 equals $844 in cash flow. They've gone from $25 to $844. We're going to use that to pay off their line of credit. I'm going to show you guys 6 months of doing this. Now, here we go. Remember, they owe $31.67, right? I'm sorry, $31,677. I'm just getting my numbers off. But anyway, now they're going to inject their cash flow. This is on a monthly basis of $844, okay? But don't forget, you're required to pay interest on that $31,677. That is $316. So we're going to do $31,677 minus $844, my positive cash flow, plus the interest that I'm required to pay. Now I'm down to $31,149. That's what they're down to, month one. I want you guys to notice something. Remember up here, they were paying, what, $819 a month? Now you guys, they're paying $316 for their interest payment. Also, here we are, month two, $31,149 minus our positive cash flow of $844, but we're required to make an interest payment on this $31,310. Now they're at a balance of $30,616. Okay, month three, $30,616 minus our cash flow, we've gotten paid again, of $844, plus $305 is our interest payment that's required on that $30,616. Now we're down to $30,078. We are rolling. If they had continued on those credit cards, you guys, they wouldn't have even got but maybe $200 that's going towards their principal. Okay, you guys, now we're down to month four. Month four, look, $30,078. We're going to get paid, inject that $844, make our interest payment this month is going to be $300. Now we're at $29,534. We're rolling. I want you to notice as we're rolling, look at this, you guys. Interest payment is going to go down. With amortization schedule, it's not going to be that way because it's front loaded with interest. Whether you make payment 1 or payment 51, it's going to be the exact same payment every single month. That's why we always say move from a loan to a line of credit. It works so much better. But I digress. Here we go. Month 5. $29,534 got paid minus our $844 cash flow plus the $294 that's due for this month for the interest payment. Now we're at $28,984. Okay, month 6. I'm going to give you about at least a half year so you can kind of see what's happening here. $28,984. We got paid again. $844 negative cash. Our cash flow goes in there. But our interest payment this month is going to be $289 for a balance now of $28,429. They have run down nearly $3,000 in debt completely, moving it to a personal line of credit. Now, if you do you keep doing the same process, rinse and repeat, they're going to have this paid off in 3 years and about 3 months. Now, if they were to look at some of their fund money and things like that and say, hey, I can probably, spend a little bit less and having fun, make it go even faster, they can run this debt down probably in 3 years. Now, remember in the beginning, I told you that this credit card right here was going to be 65 months. That is nearly 3 years ahead of schedule. Interest has been saved. And this one right here was going to be 95 months. It's almost like this is like highway robbery. They were to do this to people. But because you know how to do the velocity banking way, you don't have to do that. People say, well, it's still a loan. I get it, you guys. Personal line of credit is a form of a loan. What we do call a line of credit only because it begins to work for you. Amortization schedule, it does not work for you because for, let's say if you had a 5-year car payment, you're going to pay at least the first 3 years. You're going to inject all that money into that interest payment. The last 2 years, you're going to be paying the principal. This, we flipped that narrative. Now you're actually paying more towards your principal, running it down so much faster, and you're able to get out of these loans that are amortized for in like record time. So once again, I'm just a voice. You have to make that choice that works for you. But I say this right here is a winning combination. You can't beat it. So check out, subscribe, like, and share. Sharing is caring. And when you want everybody to know how to get out of debt, how to run those cards down in record time, to run those car payments down in record time, I'm asking you to do that. We'll see you in the next video. Bye-bye.